Mayuresh Joshi, fund manager at Angel Broking, joins us now. Mayuresh, the markets still seem to be consolidating. No clear retracement after the up move that we've seen from the 6,900 odd levels. What does that indicate to you?
Afternoon, Mini. I think clearly what you've seen with the markets over the past few weeks, there was a balanced budget which was brought through, and again the global equity market, you saw a sharp bounce back happening. The Indian markets responded equally to what the global markets were doing. But clearly I think structural re-rating will only happen once earnings visibility starts coming through and once the capex cycle starts reviving. Again, I think the markets are factoring in an RBI rate cut to come through in the April policy, and if monsoons are better than what one really expects, that will push through the consumer discretionary spending theme on the rural side, and again the budget emphasis on the rural side is going to be a big boost. So again, I think we'll be mirroring global market as the way they move, and the consolidation might continue, but a structural re-rating will only happen once the earnings and the capex cycle revives, which will take at least a quarter or two.
For the month of March, Mayuresh, FIs have been net buyers of about 6,000 crores already, and that's really given heart to a lot of the bulls in the market. We did see a spike up in inflows in October as well, and then ever since August to October and post that we've seen big sells over there. What are the indicators suggesting in terms of global money flows? Because we've seen both the commodities rebound and equities rebound. What sense are you getting?
I think that's been the general trend of the last few weeks. You've seen commodity prices move up, whether that's iron ore, whether that's steel. We've probably seen prices of crude move up significantly as well, and that is creating the risk on rally probably towards the riskier assets like equity as well. So hot money is probably coming through at this point of time. The sustainability of these flows will probably determine on how structurally the economy is placed. The Indian economy is placed very, very reasonably, in my opinion, compared to the other emerging counterparts. I think we're better off in that sense. But again, I think we'll be more prone to what the global markets will do. And if there is some amount of uncertainty over the next few months related to any of the data points, whether that be the Chinese data points, the crude moving down again, you're talking about US data points, if they start coming weak again, you probably see some slide happening on commodities, which will reflect on the equity markets worldwide, and we will respond correspondingly. So again, I think the next few months will be highly volatile, stay in the range. We might correct, we might move up, but again, I think stock specific is the way to go, and again, I think a staggered way of investing in stocks is something that I'll still be looking at.
Let's cover some of the stocks in news today, starting off with, of course, real estate stocks, which are clearly the flavor of the street today. As the Rajya Sabha passed the real estate bill, paving the way for regulation in the sector, the law will help bring in investments as well as transparency in the sector. Mayuresh, I'm going to ask you about what impact you see of the real estate bill. The brokerages have been mostly positive, but it is a long-term structural issue that the bill actually serves. Not the short-term pain of leverage of a very, weak market. How would you look at these stocks?
No, clearly, I think the bill is positive from a consumer standpoint. So it puts the onus on the builder to probably complete the project on time. There are also penalties and strict schedules that they need to follow. Yes, the negative part for the companies catering to this sector would be the kind of money required to be put in the escrow account, which will have some amount of impact on their operating cash flows. But again, I think it's the demand situation, which is largely, I think, going to be a cause of concerns for a lot of these players. You've seen pre-launches, you've seen pre-sales, which have been extremely subdued. They're sitting on high amount of inventory. They're already sitting on high levels of debt on their balance sheet. A few of these companies are better off in that position. But again, I think the demand-supply dynamics need to improve drastically for realizations to probably go up. And again, I think largely till that happens, structurally, I think the balance sheets will still remain under a lot of stress. So yes, I think the bill is a huge positive for consumers. There are long-term structural positive implications that can come out of the bill. But again, I think the general demand situation should improve, which my perception is would not be evident, at least over the next couple of quarters. So I think it's a better way to play the housing finance companies, where the asset quality stretch is much lesser, with the catering to the retail audience. So stocks like LIC, Diwan Housing, which have done pretty well in terms of asset quality, in terms of the lending book, in terms of how their advances have grown, in terms of how the NIMs and spreads have panned out. I think the housing finance companies are a much better play, in my opinion, rather than the real estate stocks at this point of time.
Interesting take, Mayuresh. In fact, earlier we spoke with Rajiv Talwar of DLF, who sounded optimistic after this bill. Listen into what he had to tell us.
We are quite happy that yes, there will be some amendments which will probably take place in due course of time, like all laws in India. But as a first major beginning, this is an extremely good step. The industry has been making very good buyers agreements, and therefore making disclosures should not be an impediment to the industry. They have been doing so regularly, but now there is a legal framework under which what disclosures need to be made public, and that will go a long way in making this industry transparent, accountable, and the consumers and buyers more confident while they're going ahead. I am quite hopeful that if there is a boom in construction, in housing and real estate in the coming years to fulfill the dream project of this government to provide every family with a pakka house, that would lead to a large increase in supply, and that is the only way to moderate prices.
Moving on now, in what comes as more bad news for PSU banks, rating agency CRISIL has downgraded 8 PSU banks. CRISIL has cited deteriorating asset quality as the main reason for the downgrade. The rating agency has also revised its outlook for 5 banks to negative. Take a look at how some of those counters are faring in trade today. They are down, but the bank nifty is actually bounced back as far as trade is concerned, which is interesting. Mayuresh, I want to ask you, but meanwhile, just an update before I go to Mayuresh. CRISIL while CRISIL has brought the rating down, Fitch has maintained that consolidation of banks would be a long-term positive for Indian banks. Mayuresh, let me come to you. Is the bad news on NPAs old story as far as you're concerned? So when a rating agency like CRISIL speaks about it, it's already factored in the price. From a stock market point of view, are they looking at NPAs or the potential consolidation? Which way are you betting, for instance?
In fact, there are multiple factors, Mini. Largely, I think the price erosion that we've seen in PSU banking stocks are attributed to the kind of worsening asset quality that you've seen and the kind of deterioration the book quality has witnessed. Now, the markets are very well aware that Q4, the asset quality pressures are going to continue on a lot of these banks. And unless the credit cycle improves, the entire take is that the end working capital requirements for a lot of these end user industries, whether that be steel, real estate, sugar, I think that is going to put some amount of additional stress onto their book. So the restructured pipeline for a lot of these banks are still going to remain extremely stressful. Now, this point is very well known by the markets. The other point that the markets are probably keenly watching out for is the kind of recapitalization that the finance minister has probably promised around 25,000 crores. Now, with what tranches does this happen, and what kind of a multiple effect will that have on capital adequacy? Because the RBI has also announced revaluation reserves to be adjusted in the tier 1 capital of a lot of these banks. So I think the banks would be probably flush with capital. But is there enough funding that is required to be done? And what kind of incremental funding will happen? So clearly, I think the pressure will continue. It's a known story to the markets. The only fear factor the markets are working off is there any further deterioration from the restructured pipeline, which is not known or which is not being disclosed at this point of time? And if that starts coming out in Q2, Q3 with an elongated cycle which does not improve, that might put additional stress onto the book. So clearly, I think the PSU stocks are fearful and mindful of that fact. At this point of time, the street is probably watching out for all these signs from a medium-term perspective.
The bank nifties again turn negative even as we speak. So there is a lot of pressure there, undoubtedly. But let's move on to another segment that is in focus. We told you first on the 11th of February that Adani Power is looking to buy some of the Naveen Jindal Group's power assets. Today, JSPL Group CEO Ravi Uppal confirmed that they are indeed in advanced talks with interested parties for the Tamnar plant. Uppal added that the company is also considering the sale of some non-core assets. Listen in.
Very, very selectively looking at, sort of monetizing some of the assets. And we do have, offers from several interested parties for our energy assets, which is in Tamnar, both from domestic market as well from international. We are studying, looking at them, and if we find them attractive, we will consider the option. And that's being dealt with very seriously.
Mayuresh, how are you seeing this whole story evolve? Because with the MMDR amendment yesterday also, there is a lot of expectation that deal making will resume, especially in cement, beleaguered steel plants, Of course, this is an older story, but do you see this gaining momentum? Because, over the last 2-3 months with global volatility and the stock markets the way they are, a lot of the deal making had kind of gotten stalled in some cases.
Oh yes, and that trend might very well continue for highly leveraged companies because their assets are not performing to their full potential. A lot of these assets are working at suboptimal utilization levels. The kind of losses that these assets are generating in terms of operating cash flows not coming through are very, very evident in terms of how the interest expenses are getting paid off even at this point of time. And I think that leverage issue might still continue. So I think the enterprise valuations of all these asset sales are going to be extremely crucial at this juncture. And again, I think deleveraging is going to be the core mantra for a lot of these companies. So clearly, I think one has to go case by case, stock by stock, company by company, asset by asset, and probably look at the EV of these assets in terms of what the top line was, what EBITDA they were generating, and what kind of valuation they're currently generating at this point of time, whether they are power assets, whether they are steel assets, whether they are iron ore assets, and so on and so forth.
Moving on, Interglobe Aviation is in focus as the company has received the first of their new Airbus A320neo aircraft. Speaking to us earlier, Aditya Ghosh said that the aircraft will provide a huge cost benefit to the company, while also saying that the 520 scheme should provide a level playing field to competitors.
About 22-23% of our entire capacity by the end of next fiscal will already be the A320neos. And the significant thing about this aircraft is that because it is expected to burn 10 to 15% less fuel, and fuel is the biggest component of our cost structure, it means there is going to be a huge benefit to our cost structure going forward as the 320neos become a bigger and bigger part of our flying fleet. Whatever be the new policy, it should just create a level playing field. Neither should it benefit us unduly, and neither should it disadvantage us unduly. And as long as that happens, I'm open to any new formulation of a policy, as long as it creates a level playing field between RDG guidelines and the 520 and so on and so forth.
Aircraft and 520 aside, Mayuresh, there's no stopping the aviation stocks with the latest round of ATF price cuts and business looking up. What's your top pick in this segment?
I think Interglobe should do reasonably better over the next year and a half. Yes, I think ATF becomes a core component in terms of the input costs. And if one really assumes that you've probably seen the bottom of crude, Interglobe Aviation has managed both its fuel requirements very well, and operationally also with the sale and leaseback agreements, the way they've got a cost structure in place. My own take is they should do extremely well going forward. With the first batch coming through of A320neos, extremely fuel efficient planes. So even if the crude prices probably go up from the current levels, you're still assuming that they're going to save a lot in terms of once the deliveries of these planes happen. Secondly, I think the staff that they've probably recruited in anticipation of these deliveries coming through a few months and quarters back, they should get deployed meaningfully. So I think the utilization levels should improve from an employee perspective as well. And third, I think the load factors are quite encouraging for the months gone by. With summer season coming around, I think we're still expecting a good quarter to come through. So yes, I think Interglobe would remain one of our preferred picks.
Fair enough. Last one I'm going to ask you is on FMCG, but let's quickly fill in our viewers with the developments over there. FMCG stocks are also on our radar. We learned that companies are looking at price cuts across products. My colleague Shilpa Ranipeta is standing by with all the details on this. Shilpa, take us through what you've got from the companies.
Well, the domino effect seems to be playing out. Input costs continue to remain low, and as a result, our household items are getting cheaper. Sources have told Bloomberg TV India that HUL, P&G and Future Consumer have cut detergent prices. Not just that, HUL has cut prices of its Sunsilk and Tresemme shampoos, but has hiked Dove shampoo's price. In the soaps category, HUL and ITC are offering various offers on purchase of 2 or more soaps. Dabur and Marico too have slashed prices of hair oil products, but P&G has kept shampoo prices intact after the last cut in August. Let's take a closer look at the price cuts, talking about detergents first. HUL Surf Excel's 2 kg pack is now cheaper by 11.5%, that is 50 rupees less. P&G's Ariel 1 kg pack is cheaper by 25 rupees, which is 11% cut. It has also slashed price of Tide's 1 kg pack by 6 rupees, making it 6% cheaper. Future Consumer, a new entrant in this space, has slashed price of its White Magic detergent by 10 rupees. Let's talk about shampoos now. HUL's Sunsilk is now cheaper by 15 to 20%, and its relatively newer brand Treseme's 200 ml pack is now cheaper by 23%. But the FMCG major has hiked prices of Dove shampoo by 32 rupees, which is a 12% hike. In the hair oil category, Marico's Parachute is now cheaper by about 15 to 39%. Dabur too has cut prices of its Amla hair oils 100 ml pack by about 10 rupees, which is an 8% hike. One point worth noting at this point is that the competitive intensity in this space is heating up, with new players like Patanjali and Future Consumer bringing in brands in these categories at much lower prices. It will be interesting to see the effect it has on competition and on prices going forward. Back to you.
Right, the Patanjali factor is something that all the FMCG companies are looking at closely. Mayuresh, the fact is that many of these stocks, and I was looking at Marico today, it's at a lifetime high. A lever also touched a lifetime high. They're cooling off. The markets at this juncture are now starting to look at some of the pressure points. But how would you read the valuation metrics over here?
Again, valuations have always been on the higher side for the sector as a whole, and the premium valuations were justified because of the volume growth that these companies had exhibited. Now, with the kind of benign input costs that we've seen, they need to push the volumes through. So I think the price cuts that you're probably indicating at this point of time is a clear indication of A, volume growth needed to get pushed through, and B, I think competitive intensity pressures playing on a lot of these companies. Thirdly, I think if you look at the cash flows are extremely encouraging for a lot of these players. But again, I think valuations appear to be headwind generally for the sector and for a lot of companies within this sector. So unless volume growth recovers meaningfully, and if one really assumes that input costs are expected to stay benign over the next few months and quarters to say the least, the margins will probably come through, the profitability will still come through for a lot of these companies. But again, at what cost is something that you need to put forth. So clearly, I think one has to be extremely stock selective within this FMCG pack and look at valuations which have probably contracted meaningfully over the past few months that we've seen in the fall. And again, I think wait for corrections to happen on stock-specific ideas which have run up significantly, because it just doesn't make sense to buy these stocks at multi-year highs or premium valuations that they are currently deriving at.
Last question before we fill our viewers in with what's happening on the whole Vijay Mallya saga. I had asked this question to an earlier guest as well in Market Movers, Mayuresh, but United Spirits, a bit of an overhang of this Mallya impact, but what's your own call on United Spirits as a stock, because it did go in for a bit of a re-rating over the last year?
So clearly, as a disclaimer, I think we don't cover the stock many, so very difficult to comment in terms of a recommendation on this one. But yes, I think what has happened over the past few weeks, what has happened over the last few days, I think that effect is clearly playing onto the stock. But if I look at IMFL as an industry, I think Radu Khetan is something that we still remain extremely optimistic about. The distillery capacity that the company's got, the kind of brand presence that they've got, the kind of branded push through that the company is trying to do. I think that is going to have a multiple effect in terms of how things will pan out. So Radica is something that we like, and whatever stocks we've probably discussed, I think we might be holding them on behalf of our clients in our PMS schemes.
Fair enough, Mayuresh. Thanks so much for joining us. Moving on, the going gets tougher and tougher for the now defunct Kingfisher Airlines. The Chief Financial Officer of KFA